I think anyone who's opposed to panda diplomacy is a curmudgeonly old fart. I am a big fan of panda diplomacy. I'm not a big fan of the fact that China doesn't liberally allow other countries to benefit from the global supply of pandas. I think China's export controls on pandas are a grave threat to human happiness. And I think China needs to share the intellectual property embedded in pandas and let other countries keep baby pandas born on their soil, not have this policy of pulling American born pandas out of America and returning them to China. I think we need the genetic blueprint from a Chinese panda so that we can have second generation American pandas.
Today's podcast is brought to you by International Intrigue, a letter delivering daily geopolitical news and insights straight to your inbox. I, unsurprisingly, spend a lot of my time myopically focused on China, but I'm also really curious about other things happening in the world. International Intrigue helps keep me up to date for just 5 minutes a day in an efficient and entertaining way, providing me the context I need on stories like Venezuela's plot to annex Guyana, Argentine elections, and India's assassination plot on U.S. territory. Sign up for free at their website, internationalintrigue.io. Link is in the podcast description. Sester, ladies and gentlemen, is a fellow at the Council of Foreign Relations and author of the fantastic Follow the Money blog about international trade flows. He also spent a year in the Biden administration at the U.S. Trade Representative. Co-hosting with me today, coming back for episode 2, is Kyla Scallon, a YouTuber, Substacker about China and macroeconomics, who also has a book coming out in early next year entitled "In This Economy?" ? Brad, I want to kick us off with a quote from Logan Wright, my former colleague of the Rhodium Group, who recently said in the Wall Street Journal that Beijing will never be able to make a credible claim to global economic primacy. China's GDP may one day reach 90% or even 100% of the US's, but there is no realistic scenario in which it reaches 150 or 200%. Implication being that, 2 to 3 years ago, people thought this was, a definite possibility, if not even kind of baked into where global growth trends were heading. Care to reflect on that, Brad? Maybe first on the sort of like analytical question of whether or not comparing nominal GDP is like a thing that makes sense when you're talking about the two biggest countries on the planet from a natural power perspective.
Well, I think the most important thing is that the US and China are the two biggest economies on the planet, and the precise size of China's dollar GDP, whether it's 10% above or 10% below that of the United States, that doesn't change the basic fact that China's a peer of the U.S. in broad terms. I think Logan is right to say that, it's like 10 years ago, there were a set of forecasts where China would be way bigger than the U.S. just because China has a substantially larger population base. And if you have a sufficient convergence to U.S. income levels with a bigger population base, you'll be substantially bigger. But the pace of convergence is clearly slowed. And, China's demography means that China's relative working age population is shrinking while the United States continues to grow. So in that sense, I agree with Logan's broad assessment that China's not going to be way bigger than the U.S. But I also think it's important for the U.S. to recognize that China is, basically an economy of the same size, maybe a little smaller. But in some ways, China's already bigger. I mean, China has a much greater capacity for manufacturing production now than the U.S. China's a bigger source of commodity import demand than the U.S. We're lucky, I guess, that our oil consumption is more or less matched by our oil production. But China has become as big an oil importer as we used to be. So they're just a set of measures that are not well captured in dollar GDP that I do think are relevant for thinking about the big, great game so to speak, between the U.S. and China.
How different would the world look from a sort of, macroeconomic and geopolitical perspective if you ended up with the not within the error bar of how you want to measure it, 10% here or there, but we were looking at a future where in 2035 or 2040, you sort of on every dimension that was relevant, China was able to keep up that 6-7% growth rate, with the U.S. still sort of like stumbling along, and it was sort of clear to everyone that on most metrics, China was the most important global economic player.
I think that's an unknowable, in a sense, question. I think, even if China would have been the biggest individual economy, the G7 collectively would have been roughly as big, if not bigger. And the G7 do have, significant, although not perfect, harmony of interests and capacity for joint action. Even with China that is only ballpark of the same size or slightly smaller than the U.S., China is still capable of constructing its own alternative systems. I mean, the Belt and Road basically was a function of China creating development banks that were on the scale or bigger than the multilateral development banks that the U.S. helped set up after World War II. China's network of trade inside Asia is quite dense. It's quite deep. It's constrained by the fact that China doesn't import that much when you take out commodities. But China exercises a substantial amount of weight in the global economy, even without having quite the same dollar GDP as the U.S. That relative weight goes up. But I think, the most important thing is not relative economic size. It's kind of cohesion of the groups that you lead. It's the structure of the institutions you create. And then it's sort of the asymmetries in a set of relationships. A China that's substantially bigger than its trading partners actually has a lot of difficulty relying on its trading partners for growth. It just mathematically becomes harder. So China's greatest scope to grow through exports, ironically, came when it was a much smaller economy, and it could generate a lot of growth relative to the size of its own economy without putting much of a burden on the rest of the global economy. As China gets bigger, that balance shifts. It becomes harder for China to grow through exports without cutting into the opportunities others have to grow through expanding their own manufacturing production. So I think, you need to look at balances, imbalances, asymmetries. And then there is a sort of tyranny of size. Big economies generally have to grow on their own accord. And then there's the more complex question about, kind of how all of this relates to military power, military capabilities, and sanctioning scope and other kind of economic statecraft, ability to use the tools of economic statecraft to achieve your way in the world. And, where there is a little bit of the bigger you are, the more influential you are, is that, even if you're less perfect at converting your power or your size into influence, if you're big enough, you're going to have influence. But my gut is that China is already big enough that it exercises a lot of influence. It doesn't punch substantially below its weight, and in some areas it punches well above its weight. And so I think it is. I at least personally don't find it enormously helpful to spend a lot of time worrying about it precisely how much bigger or how much smaller China is going to be than the U.S. in 2040.
Gotcha. Well, so you mentioned sort of institutional capacity to, translate like latent power into extant power. And, you just spent a year at USTR. What'd you learn from that experience?
Oh, I think the most important thing I learned is that I'm not really cut out to do trade policy. That trade policy involves a willingness to listen and take input from stakeholders. and I'm much more of the professorial type that likes to lecture. And I think the other thing, which I think is an obvious point about trade policy, is that trade data plays actually a very small role in U.S. trade policy, maybe too small of a role. And there's a generalized tendency to overstate the impact of trade policy on trade flows. Now, some trade policy shifts are indeed significant, like Trump's tariff hike. It was a meaningful move. It affected a significant amount of trade. The tariff was significant. So, 25% on 60-ish% of trade is a real shock. But a lot of trade policy has a great deal of public salience, but only affects very small quantities of the economy. And so I do think there's a gap between what trade policy realistically can do and what some people's expectations are of trade policy. And I think that was my perception before being in the trenches, and that remains my perception. Obviously, a big issue for the U.S. is sort of how to handle the legacy of the Trump tariffs. And obviously, in my year, there is not a lot of movement on that front. In some sense, I think the fact that the phase one targets were set at such unrealistic levels creates kind of a structural problem, because it's impossible to make an argument that China has delivered when the most visible commitments were clearly not met. Actually, there's not even any real movement towards meeting them anymore. U.S. export growth to China has kind of stalled the past year. So, you're just kind of left with an evaluation of whether you want to keep the tariffs as they are or adjust them on their own merits. That turned out to be a complex discussion. And then there was just, a lot of discussion about how to resolve the set of, rather significant, actually, set of trade actions that Trump had initiated against our European allies. And we made some progress on that when I was there. And that process kind of has slowed down. And in a sense, the discussion has shifted with the Inflation Reduction Act, which, postdated my time, but it is an enormously consequential shift in policy, one that doesn't easily fit within the existing trade institutions, one where the U.S. decided as a matter of policy, and I think with full consensus, not to make everything WTO consistent in the way Europe defines WTO consistency. There's always exceptions, exclusions. You can argue it's not there's a legal case that it is consistent, but it is clearly the U.S. decided it wanted to discriminate in favor of domestic U.S. production, North American production, in the provision of subsidies for the consumption of green industrial goods. And the theory of the WTO is that those subsidies should be provided on a non-discriminatory basis. You shouldn't penalize an American consumer that wants to buy goods from Europe or buy goods from China. And that was not the approach built into the law. And then the other problem, not a problem, but other feature of the law is that Manchin and Schumer, when they wrote the final law, they didn't work. Europe was initially treated almost in the same way as China. So our allies were not consistently given better treatment than China under that law. And I think that has created a set of frictions in the U.S. transatlantic relationship that are unique to the Biden era. So it's just a question, I think what I learned is that settling trade disputes is actually difficult, and that once any party has won a legal victory in the WTO, they don't want to give up that legal victory easily. Even if the WTO isn't functioning, you never want to give up a potentially useful precedent. So you end up settling narrowly rather than settling broadly.
Interesting. I want to come back to this point you made about like trade being like weirdly salient relative to its actual impact on trade flows. We're recording this on November 21st. There was some news that came out right before APEC. It was an FT article being like, Biden like decides not to push TPP again, like thanks to Sherrod Brown, which seems a little curious to me. But more broadly, Brad, I'm curious, like, for your take on to what extent trade deals like this actually matter.
Look, there's an easy answer to that, which is that when the U.S. did not go forward with TPP under Trump, trade with TPP countries actually accelerated rather than decelerated.
Yeah.
Why? Because the U.S. economy was relatively strong. The dollar was pretty strong. And for most goods, U.S. tariffs are either zero or low, even if you don't have a trade agreement. We always have trade agreements. And as I said, everyone who is part of the WTO benefits from the tariffs that were negotiated. And in many cases, those tariffs for everyone are already at zero. So the incremental impact of what are called free trade agreements is only on those areas where tariffs aren't already zero, and I would say where tariffs are not already de minimis.
Yeah.
And that's a couple of a few sectors. And there are a lot of things that end up having a huge impact on trade flows that are not covered by trade agreements. They're not part of the negotiations. They're narrow. So, the most obvious is that how rapidly demand is growing in the economy, how much we're stimulating. Stimulate more compared to your trade partners, you're going to import more and you're going to push your currency up and you're going to export less. Tax deals, or not tax deals, but the tax competition and deltas in the way taxes are levied on multinationals across countries can generate huge impacts on trade. So, the TPP was never going to increase U.S. exports of pharmaceuticals because major American pharmaceuticals don't produce in the U.S. for the global market. Why don't they produce in the U.S. for the global market? Because they don't want to pay tax in the U.S. on those profits. They actually don't want to pay tax in the U.S. on the profits and their sales back to the U.S. So that production was always going to happen in Singapore because that's the tax hub of the pharmaceutical industry in Asia. So, I think that people tend to think that there's not much trade if you don't have a special free trade agreement, when most countries can do perfectly well as long as they are not discriminated against and get the WTO negotiated tariff. Vietnam's exports to the U.S. have absolutely boomed. The U.S. does not have a free trade agreement with Vietnam. It would have had there been TPP. And then the other thing that really had a big impact on trade with Southeast Asia was increasing tariffs on China, which led to sort of a diversion and a shift to final assembly towards Southeast Asia, which by any reasonable estimate, the spillovers to Southeast Asia from the higher tariffs on China are way bigger than the impact of TPP. And then the sort of sons of TPP, daughters of TPP that the U.S. was trying to construct, they explicitly did not include tariff reduction. So their actual incremental impact, conventionally measured, would be small. Now, there's still some things you can do. You can do like subsidy sharing arrangements for Inflation Reduction Act green subsidies. So I think there's still scope to do interesting agreements, but those agreements are going to be a little bit narrow. And I think it's important not to think that, if you don't have there's a tendency to think that if there isn't a free trade agreement, there's no trade. Whereas I think the reality is, as long as there's not explicit discrimination that puts you in a worse position than other WTO members, most countries do pretty well trading with the U.S. There's a lot of scope for trade, even without a preferential trade deal.
So why do you think this like trade deals loom so large in policymakers' minds? Is it because they're all lawyers and they think, getting in a room and hashing things out is like a fun thing? Is it just like a proxy for a strategic alliance? So it sort of reassures allies that we're behind you and supportive. If it doesn't actually cash out into increased trade flows or like increased growth, like why are we still talking about this?
I think it's an interesting and fair question. I think the answers you put forward are reasonable possible explanations. For a lot, it is something that you can do collectively with another country. And as I said, trade diplomats tend not to focus that much on trade numbers. So it doesn't really matter, as long as you're negotiating and have an active negotiation, it provides a basis for a lot of conferences, a lot of discussion, a lot of dialogue, and it builds relationships. So, I think that's the kind of the classic case for doing it, and the classic case why it has a foreign policy impact. The downside is that even if you if you make any incremental change in a free trade agreement, you're going to get blamed for any swing in trade, even if that has absolutely no relation to what was actually negotiated in the deal.
Sure.
So I think that's why there's been a reevaluation of the political case for doing these agreements, in part because, on the upside, you probably got more credit than the intrinsic economic upside provided, because it was a form of political agreement. It looked like, a lot of people think trade agreements are trade alliances that are close to alliances. But the downside is that you also got blamed politically for things that were probably not the direct function of the trade agreement. By trade agreement, I just mean the shift from standard WTO MFN tariffs and standard WTO non-discrimination rules to the special tariffs, which will not give free trade in everything. They will give relatively lower tariffs on a broader set of goods after a lot of negotiation in a preferential trade agreement. But I think people don't generally look at the delta, they look at the outcome.
Coming back to something you mentioned earlier about China punching above its weight and mattering a lot. Let's chat debt restructuring for a little bit.
Yeah, so I know that you said that you've been doing a lot of work on debt restructuring, and there was a piece from Bank of America talking about the record debt burdens in the United States, deglobalization, demographics, as a reason that we would stay at 5%. And I'm just curious, what your thoughts are on deglobalization, especially relative to debt restructuring, how those two things tie together.
It's worth thinking about deglobalization, and it's worth thinking about debt restructuring rather separately. There is a link in the sense that as China globalized, actually it's kind of more ambiguous. As China got big, China decided it didn't want to put all of its reserves in its central bank and just buy U.S. treasuries. So they decided to do more interesting things like lend them out to partners and neighbors, including a lot of low-income countries in Latin America, Africa, Central Asia, Southeast Asia. And that was the Belt and Road. And it was a big thing that used $1 trillion or so of China's reserves in a new and creative way. I think that has created a set of difficulties that are a bit separate from the deglobalization debate. I think the operating assumption in 2005 was probably a false one. But the operating assumption in 2005, based on the previous 25 years of history, was that over time, the world would become ever more integrated. And so trade would continue to grow more rapidly than GDP. And obviously, in the first few years after WTO accession, trade grew way more rapidly than Chinese GDP. So China became very, 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 very globalized, 40% of GDP or so in exports. And there was sort of an excessive linear extrapolation of that trend because that trend only was possible with growing trade imbalances. And it was a bit of an ahistorical result in the sense that, the US, the EU, other really big economies, if you just look at their extra-regional trade, it wasn't 40% of GDP. It was more like 10. So, it's sort of China was an outlier, and the assumption was it would become an ever bigger outlier, and that was the way the world would work. And that wasn't true. it's still actually the case that services are pretty hard to trade. And there was an upper limit on goods globalization with China as the production engine meeting the rest of the world's demand. And so after the global financial crisis, there was technically, you go from an upward slope on exports and imports versus GDP to something that is more flat or declining. The flat or declining, but mostly the decline, is 100% a function of China going from this insane level of exports to GDP to back to a more normal level of exports to GDP. So that got portrayed as globalization or deglobalization well before Trump, well before the tariffs, well before the COVID shock, well before the supply chain discussion. And the interesting thing that has happened in China in the past 5 years is that if you just look at the Chinese data, China has reglobalized. Exports are rising again as a share of China's GDP, and in a not small way. If you look at China's trade surplus in manufacturers relative to world GDP, or China's overall trade surplus in goods relative to world GDP, that is back up and it's at a record level. 1% of GDP for the overall world GDP for the overall surplus, 2% of world GDP for the manufacturing surplus. So the story that I see is not one of kind of steady progress to an ever more integrated world that was interrupted by Trump, COVID, and Bidenomics, emphasis on supply chain security and friendshoring. The story I see is one where the global financial crisis did produce a shock. China responded to that shock with stimulus. China's economy deglobalized, but that was probably healthy and inevitable for a while. And now China's economy, in the face of its own property slump and in the face of stimulus elsewhere, is reglobalizing while we're talking deglobalization. So if you just look at absolute surpluses and deficits, particularly on the goods side, which is well measured, China has not deglobalized. The only place where China has deglobalized over time is on its manufacturing imports, which have just kind of trended down. The U.S. economy is not really deglobalized. Imports have been flat as a share of GDP. They haven't been going down. Europe actually hasn't deglobalized. Europe is actually importing more as a share of European GDP from China than ever. It's kind of come down a bit in the past 3 or 4 months, but it went way up in the years before during the pandemic. What has fractured is the energy supply system inside Europe after Russia's invasion. But to call that deglobalization is a little off, because that means that Europe's importing a lot more energy from Africa, from the Americas, from the Middle East. So it's just a fracturing of a regional energy supply chain. So I don't see, I think the people tend to assume that the Trump tariffs and the current emphasis on friendshoring and supply chain security has led to greater concentration of trade among friends. And I don't think that's really true. And I think the way that you see is not really true is that when you look at the overall surpluses and deficits around the world, they are up. And the overall deficit of, say, the G7 with China and the world's autocratic oil exporters is up. So that's the sense in which I don't think deglobalization is a useful narrative device for framing a much more complex reality. We're still pretty dependent on China. China is still really dependent on the U.S. for the aggregate demand that allows its big manufacturing surplus. Supply chains have lengthened. Parts have to go to Southeastern Asia and Mexico before they're assembled to avoid the tariffs, but the underlying interconnections haven't gone away. So that's my rant on deglobalization. On debt, it's just, China really did lend a lot of money. They lend a lot of money to a lot of risky places. They are not the only people who've lent money to many of those risky places. Some countries access the bond market as well. There are legacy debts to the Paris Club. The World Bank never completely stopped lending. So the restructuring cannot just be handled by the Chinese with themselves, because other players do have a lot of exposure. But China's too big not to be part of a coordinated restructuring. And finding ways to coordinate with China has been incredibly difficult and incredibly slow. So we're sort of inching towards progress, but that progress is difficult. And what I think I've learned in the past couple of weeks that I hadn't fully realized before is I think the Chinese thought that there was a set of agreed rules, and those rules were well structured, well established, and that China just needed to learn those rules and everything would be, simple. So it was a process of integrating China into a defined rules and China making a decision about whether those rules were in its interest or whether it wanted a different system. What I think the reality is that the debt restructuring rules were a bit outdated, particularly for low-income countries. And so they had to be adjusted on the fly to make things work, which wasn't surprising because there hadn't been a lot of restructuring for 20 years. But from the Chinese perception, it's like the rules are being changed on us just as we are trying to learn them. Are they being changed to disadvantage us? And I think the answer was generally no. The answer was that the rules were just in some very technical ways a bit dated and had to be adjusted. But when you're doing that and you're also trying to integrate not just one, but like 4 or 5 big new Chinese state actors as creditors, things got bogged down.
So Brad, let's take that and continue it with Zambia as a case study.
Zambia borrowed a lot of money from China XM. It borrowed some money from Chinese commercial banks, sometimes in joint projects with XM. There was a big hydroelectric power project. Borrowed some money from China Development Bank, but it borrowed significant sums from China. So China has at least 6, maybe 7 billion of Zambia's 20 billion or so of external debt. That's a lot. No doubt China is the biggest creditor if you can aggregate the debts of all these different Chinese institutions. And within that, China XM had 4 billion in exposure. So China XM on its own was clearly the biggest single creditor. But Zambia had 3 billion in international bonds outstanding. Foreign investors had bought maybe 2 billion, but it's kind of hard to measure, of Zambian local currency bonds. Legacy lenders in the advanced economies in Israel had lent maybe 2 billion. Some banks around the world, not necessarily in the U.S. and Europe, had lent 1 billion. So you're left with a world where Zambia clearly couldn't pay everything that it had borrowed. B, the IMF was insisting on real debt reduction. C, that debt reduction had to include, at a minimum, both China and the foreign currency bondholders. Zambia and the IMF didn't think the foreign-held local currency bonds needed to be included in the restructuring. I think that's right. But that created a lot of complexity just because of the way those cash flows worked and the way that they had to be, the way you had to sort of figure out how to adopt rules for low-income country debt sustainability, which were developed on the thesis that the only lenders were hard currency lenders. And there's a certain longer-term structure usually there to this new world where there's a little bit of foreign holdings of local currency debt, which had a shorter maturity. So it created some technical difficulties. And then you just kind of have to sort out a whole bunch of difficult questions with new actors. Like, usually the Paris Club does maturity extension, bondholders do debt write-downs, and they get paid back a little more rapidly. Well, in the Chinese case, historically, the Chinese haven't actually preferred to extend out that far. And the Chinese have some doubts about how many concessions they are willing to make in the near term to create space for bond repayment. Equally, the bondholders are uncomfortable fitting into certain of the parameters that were negotiated with China. And then it's a constantly evolving discussion about who China is, like which part of China is a quote unquote official creditor that negotiates with the official creditors, and which part of China is a commercial creditor, and are the commercial creditors, which are also Chinese state banks, going to do the deal that the Ex-Im Bank and the other official creditors did, or are they going to want to do the deal that commercial bondholders negotiated? And the net effect of all this was that China integrated into the system, not as one player, but as many. There's a lot of Chinese creditors on, well, not a lot, but Ex-Im is the biggest creditor, and it's the biggest creditor on the official creditors committee. And CDB, ICBC are amongst the biggest parts of the commercial creditor universe, although they don't negotiate with the bondholders. And the combination of this is it introduced a lot of veto points into the process. And so the process has gotten bogged down at multiple points. We're 3.5 years in, we're close to getting a deal. But, you're really now haggling over how much more cash up front can bondholders get than the official creditors, reading Ex-Im, and how much extra effort do they have to do in other ways to get that disproportionate share of near-term cash. So that's the negotiation that in some sense was always going to be a hard sticking point that should have happened a couple of years ago. We're finally gotten there, and it's gotten tense. I probably haven't done a great job of pulling back. I'm in the weeds. The big pulling back thing is we're working through in real time how to restructure the debts of a country that going forward is going to rely on the IMF, the World Bank, donors in the G7 for most of its financing, that has borrowed a lot from China, that has borrowed a little bit from the bond market. And so the interests of all three groups have to be somehow accommodated and respected in the restructuring. And this is taking place, unlike some of the other restructurings, in a fairly transparent process, because that was what was agreed in the common framework. But the net effect of a transparent process that has a lot of requirements, procedural requirements, is that it becomes incredibly slow.
There's another country that's doing something interesting with their financial situation. So Argentina is talking about re-dollarizing. So I'm curious for your perspective on this narrative of rotating away from the dollar. A lot of people think we'll rotate to China's currency, but why do people want this de-dollarization story to be real? Like, why are people rooting for the empire to fall here?
Maybe the Bitcoiners are rooting for the dollar empire to fall because they believe their crypto empire will rise out of its ashes. The Chinese and some others worry that the U.S. and Europe, like the sanctions against Russia are G7. They're not primarily American. They are American, but the biggest and most impactful ones are European. People are nervous that the dollar payments can be weaponized, and there is legitimate concern if you don't share the United States values and you believe that you could become a target of the weaponization of the dollar in a sanctions game. You sort of think about ways in which you can minimize your vulnerability to sanctions. So that's the sense in which I think there is a discussion about de-dollarization, and in some sense, it's if you think about the Saudi-China swap line, the basis for that is sanctions protection, sanctions insulation in a world where the Saudis don't believe their interests are completely aligned with those of the United States. They aren't completely aligned with China either, so it's kind of makes it a little bit more complex. Argentina is interesting. Argentina has always been one of the countries in Latin America that has flirted with dollarization. They flirted with dollarization in the 1990s. What was called convertibility was a one-to-one peg between the peso and the dollar, where the central bank, at least in theory, held enough reserves to always back the pesos in circulation completely with real dollars. They kind of violated that in some technical ways at the end. But Argentina, there's always been an open question about whether Argentina would be better off with some variant of no monetary autonomy, adopting the dollar, avoiding inflation, or whether Argentina would find it difficult and perhaps impossible to live within the constraints created by a hard dollar peg or full dollarization. Because then you have to actually have liquid dollars to settle a lot of internal payments. and Argentina doesn't actually have that many liquid dollars. What's became really interesting over the past couple of years is that, the previous president, President Macri, went out and borrowed a lot of money from the bond market, couldn't pay it back, ended up in default. Borrowed a lot of money from the IMF, couldn't easily repay it. Then the subsequent Peronist government under Fernandez didn't have access to either the bond market or to the IMF. They renegotiated the bonds. They constantly negotiated to push out payments to the IMF. So without access to new dollar borrowing, they drew down their dollar reserves in the face of various adverse shocks, COVID, some internal economic mismanagement, a very real drought, which has really cut into Argentina's exports this year. And so they drew down their dollars. So there were no dollars left in the central bank. But they had this swap line with China, and they started using the swap line with China to make payments, including payments to the IMF, including payments to bondholders. So people sort of view the swaps and greater use of the yuan as this great threat to the United States. But in practice, the yuan swap line has been used to make sure that, Argentina, in a sense, doesn't default on the IMF, which is the U.S. in coalition. So the world becomes complex and messy. Milei, the newly elected president, when he takes office, has said he wants to fully dollarize. He says he doesn't want to deal with China. I mean, I think the Chinese are communist. He's a anarcho-capitalist. But his predecessors borrowed, they got a 20 billion swap line. I think they've used 10 of it. So, you're kind of in bed with someone already because either you default on that swap or you have to come up with the yuan to pay China back. And if you have to come up with the yuan to pay China back, you probably need dollars to convert into yuan, and you don't actually have any dollars, and you want to dollarize, which also takes dollars. So in a financial sense, it literally is a mess. It is intellectually intriguing just because the central bank in Argentina is really out of dollars. They were making payments in yuan because they didn't have dollars. Now, technically, they have a few dollars, but those dollars are the bank's required reserves. And even Argentina doesn't want to use the bank's required reserves to make payments that are not back to the banks. So that kind of just guarantees that the dollar deposits will leave the bank. You'll have a bigger problem in a run. So in terms of ability to use dollars, you kind of have to have dollars, and Argentina doesn't have any usable dollars. We know that. They've had usable yuan. The new president doesn't want to stay on China's good side, so they probably won't have any more usable yuan. And he has an economic plan that requires a lot of liquid dollars, and he has none. So it's kind of promise meets reality.
How is that? Is that going to work? It doesn't sound like it's feasible at all for them to re-dollarize.
I think you correctly read my skepticism about its technical viability.
Mm-hmm.
If he can scrounge up 5, 6, 7 billion, he can replace the pesos in circulation with dollars in circulation. I think that's the maximum that can be done. And then you still can't really get rid of pesos if the central bank still has to pay its peso debt in pesos, and the government still has to pay its peso debt in pesos, and the banks still have peso deposits. So even if you reduce the number of pesos in circulation, you still have to deal with this stock of peso debt. And so to fully dollarize, you have to convert that into dollars at some exchange rate. And in all probability, you would have to restructure to handle these claims because there aren't actually dollars to settle all of the debts that the central bank has taken on in pesos. There aren't dollars to settle the debt that the government has taken on in pesos. So it does seem rather difficult. If you're determined to do it, you would just end up in a world where there's an inevitable, very broad restructuring of all the newly dollarized claims that cannot be paid on their original terms. But you're right, I am skeptical.
So, Brad, you did your tour at USTR, but now you got two options: Zambia or Argentina. Which economic ministry would you rather hang out in for the next 24 months?
I think given that I would be rather completely at odds with the new president of Argentina, I'll pick Zambia. But the easiest answer is, you know, the fun job is being the debt advisor to Argentina as they restructure. And I do think that will be one of the more interesting jobs in the international financial world over the next few years.
So I want to switch lanes again because I saw this interesting chart that was talking about how pork prices are driving a lot of the deflation in China. And I think that's sort of interesting because it's really hard to get a good picture of certain economic situations. And oftentimes we can think that there's deflation happening in China, but it might just be pork prices. Could you talk about that relationship? Like, is it really just pork prices that's driving a lot of what we're seeing in China, price movement wise?
Well, never underestimate how important pork is to the Chinese CPI. This wouldn't be the first time that pork has been an important source of volatility in prices. The Chinese do have a strategic pork reserve, famously, and I think that's very wise given how important pork is to domestic stability inside China. But I do think it's probably a bit of an exaggeration to say this is just a pork move. Clearly, real estate prices, well, they are. I mean, they are actually a little bit, I think, coming down, but they aren't being allowed to clear. But there's an excess of supply of apartments, and if the market were really allowed to equilibrate, the price of apartments would be coming down. Demand inside China has been pretty weak. Countries don't usually get so much growth from net exports if internal demand is strong. And China's gotten, it won't get so much this year because, global consumers got satiated with goods after spending their pandemic stimulus dollars on, a new food processor, a new computer, or a new phone. And they just had a natural pullback. But in 2020, 21, and 22, China got, on average, a percentage point of growth from net exports, which is usually a sign of an economy with weak domestic demand. And so I do think that, when you look at China, the productive capacity for goods is going up much more faster than internal demand for goods is going up. And, it's a little harder to get a clear read on services. There's an oversupply of housing. There's an undersupply of completed apartments relative to the Chinese people's expectation that having pre-bought an apartment, you'll get an apartment. And so, completions have slowed. But if you ignore the pre-sales issue, which is a real problem, there's a glut of available apartment supply relative to current demand. So I don't think it is just pork. I think there's a broader problem of demand, a broader problem of an unrealized, of an yet unresolved domestic real estate crisis that is putting structural pressure on Chinese activity and on Chinese prices. So I think it is actually real. It is certainly the case that China didn't stimulate household demand in the way that the U.S. and Europe did in COVID. And it is certainly the case that prices outside China have shot up over the past few years, while prices inside China have not. On top of that, there is a classic hog cycle. Back when we were an agricultural country, hog cycles, egg cycles, classic agricultural economics did actually have an impact on overall prices. It still does. When milk prices went up, people were very upset here. So pork prices are a factor, but I don't think they're the full story.
And why hasn't China wanted to do direct transfer for household support? They seem to be avoiding that. That would stimulate demand.
Yeah, I mean, maybe Jordan has a theory. Look, I think it's now almost overdetermined. It would stimulate demand, but there are a couple of constraints. One constraint is that President Xi seems to personally be opposed, which is an important factor in China's political system. He believes, he's written about the dangers of welfareism. And he sort of thinks that if you send a check to a household and they buy a bunch of Chinese goods, you actually haven't gotten anything. Where's the asset? Whereas if you send channel money through the state banks to build a new semiconductor factory, you'll end up with an asset, with a factory. So he has preferred not to provide support to households. And he has preferred to want to sort of build up the capital base of China rather than, send money to households who then spend money on haircuts. And then what have you gotten? You haven't even gotten any goods. And then finally, a lot of Chinese policy has been driven by a somewhat arbitrary constraint, but it's a constraint that's persisted over time. And that constraint is that China's tried to keep its central government headline fiscal deficit, which matters in the sense that it is the part of the fiscal deficit that is financed at the lowest cost by issuing safe Chinese central government bonds, of which there aren't many. So it's not just, it does have an economic meaning, even if there's a lot of off-balance sheet borrowing. But China's tried to keep the central government fiscal deficit below 3% of China's GDP. Sometimes through accounting gimmicks, but often by just limiting what the central government does. And so if you're going to abide by that constraint, you're not going to have money at the central government level to send out checks. Local governments can't borrow at as low a rate. They are right now really financially stretched anyway, and they don't want to take on this responsibility when they also have to bail out a bunch of property companies. They have to sort out their own finances with fewer land sales revenues, so forth and so on. So those are the dominant theories, but it is a strange feature of China's political economy. The other strange feature that I think people in the US and in Europe, Japan don't fully recognize is just how regressive China's system of taxation is. Nothing from personal income tax, 1%, a little over 1% of GDP. US gets 8%. And the revenue mostly comes from VAT, which is a regressive consumption tax, and from social contributions, which are structured in a way that once you join the formal labor force, you have a big pay-in. So relatively low-wage workers pay a higher share of their salaries in social contributions than wealthier workers. So the net effect is one of the most regressive tax systems in the world, which pulls money out of lower the bottom 50% of China's workforce, and they don't get much cash transfers back. So I don't think it's a surprise that consumption is weak, but it is a choice, and it's a set of bad choices, and it's a set of choices that increasingly have negative spillovers to the world. But, you can sort of tell these are the things that I think actually end up in the long run really driving ultimately a lot of trade flows. You don't have household support, your consumers can't spend, you don't import, and your economy grows through exporting. But it's not something you kind of classically negotiate in a trade negotiation.
And they also have this overcapacity situation too. I think it was an article from the New York Times that said that China had enough factories to produce enough cars for the United States, China, Europe, and the US. So the US, China, and Europe. So enough factories to produce cars for all of those places. So how does that overcapacity situation tie into the economic outlook for China?
Well, it raises questions about whether she is right that you can keep on building factories without causing problems. Like, she wants to build more factories because he thinks he will have more assets, more physical assets at the end. But if you have a bunch of factories that can't produce, that's also a problem. Just because you have a factory doesn't mean there's demand for the factory's output. It also means, that there's pressure to use those factories to meet global demand. We've seen a really big rise in Chinese auto exports. A portion of that is high-end EVs. BYD, Tesla loves the economics of the Shanghai Gigafactory. But a significant part of China's export growth are lower-end internal combustion engine cars that are going to emerging and frontier markets globally, where China can now supply completely functional cars, not decked out SUVs for the US market, but functional smaller cars at a very low price point. And so you see pressure to export. And you see a huge growth in Chinese export capacity. I think there's a generalized issue with China where, because the central government values physical output, it likes to see an expansion of supply. It is prioritizing investments in new sectors and catch-up sectors with some success in, say, electric vehicles, where China is undoubtedly a leader. And then you have a lot of local governments that want to position their local economies to meet this goal of providing this supply. So they provide subsidies to producers locally. And then you have banks that are quite willing to lend to enterprises that have local state sponsorship. And so in industry after industry, you find that capacity expands without clear reference to actual demand. And that does introduce distortions into the Chinese market, distortions into the global market. Sometimes it works. I mean, China's hefty investments in solar PVs have brought down PV prices. And that has been important in encouraging the expanded use of solar. China's built up, essentially, China built up EV capacity really fast, and it already had built up internal combustion engine capacity to meet Chinese demand, and then some. So when you have the EVs on top of the internal combustion engine capacity, the overall amount of capacity far exceeds Chinese demand, and Chinese vehicle demand is bigger than US or European. So you have this enormous capacity. The counter argument is that the U.S. isn't going to start buying the kind of small cars that China produces. So China cannot meet U.S. demand for big old SUVs. But China's...
I feel like if you can build a small car, you can probably build a slightly bigger car, too.
Well, this is one of those cases where trade policy does matter. The big ones face a honking 25% tariff.
Let's stay on that for a second, Brad. Like, does it make sense? Like, where do you draw the line for a sort of industry that's like strategic enough to deserve, trade protection?
I think it's ultimately a judgment, ultimately a political call. I have no personal difficulty saying that since the green transition is being subsidized, the subsidies should flow to manufacturers in the United States and in America's friends. China clearly made that call when it decided to build up its own green industry. It had strong localization requirements. In order for Tesla to sell in China, Tesla had to build a factory in China. Same as was true in wind way back at the start. And certainly was true for high-speed rail. So that I think when you're transitioning to the new industries and you're relying heavily on government subsidies, there is a reasonable argument that you want those subsidies to build up your own industry. And I certainly think the interesting question is not whether you're going to let the subsidies flow to China. China didn't let its subsidies flow to the rest of the world. The symmetric result would be China subsidizes China and the rest of the world subsidizes the rest of the world. The difficulty is, the US and Europe and Japan haven't agreed to share subsidies. So we don't have reciprocal arrangements amongst the G7, amongst our friends, amongst our allies. That worries me more than the lack of complete openness with respect to China. I do think chips are significant, foundational, cutting edge. And I do think that across a set of industries where, the frontier of human achievement is advancing very rapidly, you can make a strong argument that the world's biggest economy should have capabilities at that frontier. And then that case becomes even stronger when there are clear military applications, either at the frontier or at the lagging edge, because you're not going to have one generation old semiconductor plants unless you built cutting edge semiconductor plants 10 years ago.
Sure.
So I think that there are a set of reasonable choices there. I think there's some other sectors that are strategic that we haven't done as much. Personally, I think we should be doing a lot more, probably not trade protection, but investment in pharmaceutical production, active ingredients. It does worry me if we rely on one country with a complicated relationship like China for our full supply of certain essential medicines. It seems to me reasonable to want multiple centers of global production for medicines, which in a crisis, and if there is a crisis that forces rationing, the rationing will always favor the country of production. I think that's a clear lesson. I think it is reasonable for Africa for that reason, even though it's more expensive, to want some of its own vaccine production. You have to, on medicines, you have to worry about worlds where demand exceeds supply, and we don't allow supply to just flow to the highest prices when human life is involved. But then going beyond that, it is a debate, it's a discussion, it's a continuum.
Can we stay on the like cross subsidization across the G7 for strategic technologies point?
Sure.
What would your ideal vision of that look like?
What I think the U.S. should do, and what I think Europe should do, is it's most easy to explain with the highest profile example, which is the electric vehicle subsidies. The pure free trade approach would say you're subsidizing green vehicles because you want people to use more green vehicles. If China can supply EVs at a lower price point, your goal is more green vehicles. It's not more domestically made green vehicles. I wouldn't go that far. I mean, I think China reserved its EV subsidies for cars that were made in China with a Chinese battery, and often with a battery made in China by a Chinese firm. The reciprocal policy, it would be that U.S. EV subsidies are reserved for U.S. made EVs. That is literally China's policy with U.S. made batteries. I think that is a little too restrictive. I think Europe, which now is trying to launch a within the WTO rules trade case against China, but doesn't want to do Buy Europe on its EV vehicle subsidies because it's a technical violation of the WTO provisions on non-discrimination, should just kind of get over its concerns about technical violations of the WTO, do what China did, do a Buy Europe provision for its EVs, and then the U.S. and Europe would both have subsidies that go to their own production, and we can agree to give Europe reciprocal access to our subsidies, and we would get reciprocal access to European subsidies. So American companies or European companies producing in the U.S. could make an EV with a U.S. or European battery and sell it either in Europe or the U.S. and qualify for each other's subsidies. So you call that subsidy sharing. You can call that a lot of different things. Technically, is a violation of the WTO, looks like a violation of the WTO principle of non-discrimination. It is functionally fully reciprocal because China has set up its subsidies in ways that only cars that were on its list ever qualified and no import ever qualified. So I don't, substantively, it's a reciprocal response to China, but it is liberal in the sense of allowing great scope for trade between allies, between friends. And, the same basic idea could be extended to Japan. And that's kind of what I think makes sense. You can extend that to some other sectors. For some other sectors, it doesn't work. But for those sectors where the U.S. and Europe are both subsidizing the consumption of strategic goods or the consumption of green goods, those consumption subsidies could be shared reciprocally with production on either side of the Atlantic, or with Japan, either side of the Pacific.
So we're talking a lot about global cooperation, how countries are getting along, and you recently published this piece talking about special drawing rights. Could you talk about this key feature of the economy, how they came about, what they are, and why they're not working anymore?
I'm not sure they ever worked. They used to be kind of this small esoteric part of the IMF's balance sheet that no one paid any attention to. SDR stands for special drawing rights. It is technically the IMF's own special currency. It is composed of a basket of 5 global currencies, dollar by far the biggest, then euro, then the yuan, debatable, then the British pound and the Japanese yen. But when the IMF creates SDRs, it basically just lends its members an SDR forever. Well, it just gives you a permanent loan of SDRs. You do have to pay interest on it. The interest is the composite interest rate on its for the 5 component currencies. It used to be 0. Now it's like 4. But you also get credited in your SDR account with the IMF an equal sum. So if you do nothing, IMF has lent you SDRs forever. You're paying interest on your SDRs back to the IMF forever. But you have an SDR in your account at the IMF that is collecting interest. You just collect interest on that forever. So there's, in some sense, if you don't use the SDR, nothing happens. And most SDRs, it turns out, are generally not used. When there were only a small number of SDRs, no one really cared. But in the pandemic, there was an agreement to kind of ease global financial conditions, help out low-income countries by providing a 500 billion SDR, like $600-ish billion allocation of SDRs. Like 25 billion of that went to very low-income countries. And that really did actually help a lot of really low-income countries. They did use the SDRs. Now, how do you use an SDR? You take your SDR to a special trading window at the IMF, and you exchange it for dollars or euros, and the provider of dollars or euros gets your SDR, and they will have a positive SDR balance at the IMF, and they'll get interest on it. So it's just, you have to go through this special window. You can't just go into the market and sell your SDRs. And then a set of countries which aren't low income, but are in trouble, got a lot of SDRs, and some of them use them. I mean, Argentina, before it used the Chinese swap line to pay the IMF, used the SDR allocation to pay the IMF. A lot of other countries use this to pay the IMF, which freed up a bit of cash during the pandemic. But the bulk of the SDRs ended up on the balance sheet of the G7 countries and China, Saudi Arabia, some wealthier emerging economies. So they're generally speaking, they haven't been used. Now, if you don't use them, there's no pressure on the system. But if you want to use them, you're going to put more pressure on this voluntary trading window at the IMF. And so what I have tried to argue is we need a system where more of the SDRs that were handed out to the G7 countries, to the US, are actually used. Some people use them by lending them to the IMF, and then the IMF on-lends them. I think the capacity of the IMF to do that is somewhat constrained, particularly going forward, because the IMF is a balance of payments lender. It doesn't really do project finance, not really its mission. So what I and a co-author, Stephen Paduano, have suggested is that the World Bank should issue SDR-linked bonds, get a bunch of SDRs from the G7 countries, and then go to this voluntary trading window and swap them for real currency. Right now, it's a small market, and the people who supply dollars and euros against SDR tend to be the G7 countries. So what I and Stephen have suggested is there needs to be a broader rethinking of the system where countries with a lot of reserves like China or Saudi Arabia or even Brazil or India contribute to the function of the SDR system by buying SDRs in the SDR window, handing up some of their dollars and euros. So it isn't just the US, the UK, the Euro area countries that provide liquidity. It is all countries with really big reserves. Switzerland, Singapore, Taiwan, technically not a member of the IMF, so can't do it. But, conceptually, big reserve holders. And then the countries that are sitting on reserve SDRs now that don't have a way of using them would buy these SDR-linked bonds. The World Bank would get very long-term funding, which I think would let it stretch its balance sheet a little further. And the countries that give up their SDRs would get these SDR-linked bonds. They actually would settle in dollars or euros, so they could be sold in the market. So the idea is to kind of get the SDRs flowing from the balance sheets of advanced economies to the balance sheets of countries with big reserves, get them flowing through the World Bank, and provide this long-term stable source of funding for a World Bank that is better able to grow, can make use of new capital more efficiently because it can mobilize very long-term, relatively cheap, not zero cost, you have to pay the SDR rate, but relatively cheap long-term funding and put it to good use. And, the World Bank can lend for projects. It's a development bank. We need to kind of remember the value of a development bank. We can learn a little bit from China there.
I think specifically, like what a lot of people are worried about is tipping points, like what's going to change everything. Is there a tipping point that you're watching or something that you're like, okay, this could definitely change a lot of stuff if it does happen?
Yeah, I mean, doesn't seem like it's going to happen, but one tipping point that I am worried about is, if China really decides to let the yuan depreciate by a big sum, if China cuts interest rates to 1 and lets the yuan go to 8, to me, that's a bit of a tipping point. It would be a China that recognizes and kind of gives up on trying to grow internally and just is looking to export its way out of the property mess. So that's one tipping point. The other ones are kind of boring. Go ahead.
Why does depreciation make domestic growth more difficult?
No, it's not that depreciation makes domestic growth more difficult. It's that China would depreciate because there is no domestic growth. It would then grow on the back of exports. So you can view it as a choice to use exports rather than to break dishes, change domestic policies, do household stimulus. You can view it as a policy choice that substitutes. Or you can view it as evidence that China has run out of scope to do conventional stimulus. And so it has to, if it wants to recover through external demand. And an already imbalanced China will become an even more unbalanced Chinese economy. So it's partially because it's a choice. It reflects an internal decision, and partially because it's a reflection of internal weakness. The other tipping, I think we're at a tipping point for a lot of weaker borrowers in the global system, with long-term U.S. interest rates of 4 to 5 and short-term rates over 5. So I think it is not too much to say that we're in an unstable equilibrium where there are a lot of countries that cannot refinance when they have to compete against safe U.S. Treasury bills that pay 5%, but they haven't yet defaulted and they're running down their reserves. And I think at some point that unstable equilibrium has to get resolved. Either it gets resolved through a lot of emergency lending to strategically important countries so they can pay their debts and cover their fiscal deficits, or it gets resolved through default, or it gets resolved because the path of U.S. interest rates changes and U.S. rates come down. But I do think, there is conceptually a tipping point where the set of countries in debt distress is not limited to sort of Zambia, Sri Lanka, Suriname, and Ghana, and it includes much bigger, and in some cases, much more strategically significant countries. So that's another tipping point. Well, I guess the other potential major tipping point would be, if Sino-American rivalry becomes something that escalates and becomes a true Cold War, worse, and we go from talking about de-risking to actually de-risking. And I think there's been a lot more talk about decoupling, de-risking, and deglobalization than there has been actual de-risking, decoupling, or deglobalization. And so if we felt compelled to or chose to move to a world of true de-risking, you can debate terms. I think de-risking is actually more demanding than decoupling. Like if decoupling means you have less bilateral trade between the U.S. and China, that's not that hard to achieve. You buy Chinese goods through Southeast Asia. So parts go to Southeast Asia, screws get put on, and you buy the goods. To me, de-risking means you don't have critical components that are sole sourced from China. That's more demanding. So to get there, I think that would be really seriously moving in that direction would be another tip.
So I am curious too to ask you about this. China gave the United States some pandas. What do you think about panda diplomacy?
I'm a fan. I think anyone who's opposed to panda diplomacy is a curmudgeonly old fart who did not enjoy a stuffed panda growing up. And you can debate the ethics of zoos and so forth and so on, but pandas are lovely zoo animals. They just like to sit around and look cute, and they're very happy staying in one place and eating bamboo. I am a big fan of panda diplomacy. I'm not a big fan of the fact that China doesn't liberally allow other countries to benefit from the global supply of pandas. I think China's export controls on pandas are a grave threat to human happiness. And I think China needs to share the intellectual property embedded in pandas and let other countries keep baby pandas born on their soil, not have this policy of pulling American-born pandas out of America and returning them to China. I think we need the genetic blueprint from a Chinese panda so that we can have second-generation American pandas. But a shortage of pandas is a problem.
Brad, I mean, look, de-risking, like how hard can it be to take the DNA samples? I think I might take this investment over the pharmaceuticals. That bridge we can cross, we'll cross that bridge when we come to it. But a strategic panda reserve
maybe we have to do something drastic, like collect. I guess a lot of pandas are now born out of artificial insemination. They are bears. Maybe you can get a black bear. But I think like pandas, they're kind of weird bears. They don't eat what other bears eat. It may not be as easy, but yeah, this is a problem that American ingenuity needs to solve. I mean, we have great panda exhibits in multiple zoos, and we have to go to Europe to see a real live panda. It's an outrage. And I am, it's bidirectional. I think
China should get all the brown bears and bald eagles at once.
Yes, there's no shortage of bald eagles in rehabilitation. I think Xi went a little too far when he, trade war is one thing, but pulling all the pandas back to China, it's only so he could make a magnanimous gesture by sending a few back. I mean, to me, it reminds me of how China XM approaches Pakistan. They demand repayment, and then 3 months later, they give them a new loan. But they always, want the old generation to be repaid before you get the new loan. We had to give our pandas back before we could get new ones. It puts China in a structural advantage because, the pandas are important.
But I think it actually makes them look more obnoxious. Like, I don't think that whole like two-step of like, we're going to take them away and we're going to give them back, I don't think that makes them look any better. I don't really understand.
It makes it look
highlighting, like highlighting the dependency every 4 years or so when these leases run out. This is what's going to
spark
negotiating
new
leases.
I mean, it should just be. Yeah, I agree. And it's it is unfortunate, but it is true that I do not think giant pandas managed to cross the Himalayas. So I think they're only in the bamboo forests of China. So like it is really a product that is sole sourced from China, not through industrial policy, but by nature. But it does have global appeal. A world where only China can benefit from pandas is a poor world.
I think there's probably some really cool like trade flow map of like all the loans that go between all the zoos in the world. We'll try to look that up. That seems really cool.
Yeah, there no doubt is, and I'm sure some diplomat has gone to the Chinese and shown how the U.S. is being discriminated against in the global allocation of pandas. So we've gone from being the preferred location for pandas to being the least preferred. But, 737s matter too. It'd be nice if China bought a few again, and maybe a few 787s. I'm not sure China wants to be sole source dependent on Airbus. The C919 is not going to meet all Chinese demand. So there are other important issues which are kind of just.
Brad Sester and Kyle Scallon, thank you two so much for being a part of ChinaTalk. I hope you enjoyed this episode and this year's worth of free ChinaTalk content. The most helpful thing you can do for the show is to share it. Post on Twitter, share in group chats, or even an email. Thank you so much for listening, and see you next time. For our music this week, we've got I Hear a Rhapsody, a jazz standard recorded in 1962 by Bill Evans and Jim Hall.